Genuine Parts Company actually beat their internal profit expectations for the second quarter of 2026.
Right out of the gate, yeah.
Yeah, they reported revenue of $6.5 billion, which is a solid 6% increase year over year.
And if you look at the bottom line, the adjusted diluted earnings per share hit $2.15. So that's up from $2.10 last year.
But the GAAP earnings completely missed that mark. They came in way lower at $1.65.
Huge difference there. But management still reaffirmed their full year 2026 adjusted EPS guidance. They're sticking to that $7.50 to $8 range.
And they also maintained their total sales growth outlook, right? The 3% to 5.5%.
Exactly. So the headline numbers look really solid on the surface, but to understand the mechanics of this quarter for this deep dive, we really have to look at the gap between that adjusted EPS and the GAAP EPS.
Yeah, that 50-cent difference.
Right, because it reveals a lot about the massive transitional phase the company is going through right now.
Okay, let's unpack this because it's a really interesting margin story. When you strip away all the noise, the adjusted gross margin actually improved by 20 basis points.
Yeah.
So it's sitting at 37.9%.
Which is great. I mean, it shows they either have some serious pricing power or they're just executing really tight cost control at the gross level.
But then the adjusted EBITDA margin actually decreased by 20 basis points, down to 8.7%.
Yeah, so they're making more on the actual goods, but it's costing them more to run the daily operations.
Exactly. But that massive 50-cent gap between the $1.65 GAAP EPS and the $2.15 adjusted EPS that is driven by $69 million in after-tax adjustment.
Right.
And that's all tied directly to their global restructuring initiative and the upcoming corporate separation. It's basically like remodeling a house while you're still living in it.
That is a perfect way to put it, actually.
Right, like the core structure, the adjusted EPS, is appreciating in value. It's operating well. But the immediate construction costs, the lawyers, the consultants, that's all reflected in the GAAP EPS. And it's making the current picture look a bit messy.
It's extremely messy, but analyzing the core business really requires looking past those separation costs. We have to see how the underlying business segments actually performed.
Since this remodeling is, planned to split the house in two, we should probably examine those specific segments.
The ones slated for separation, yeah. Industrial and automotive.
Right. And industrial is just the absolute star here. They pulled in $2.4 billion in sales, which is up 7.1%.
But the standout metric there is the comparable sales. Organic growth increased 6.1%.
Wow. In this macro environment, that is huge.
It really is. And segment EBITDA jumped 9.8% to $316 million. So they are operating with this incredibly robust margin of 13.1%.
13.1%. That is fantastic.
Yeah. And they're seeing growth in 11 of their 14 end markets, like MRO maintenance, repair, and operations. That grew by roughly 7%.
But the thing that really caught my eye in the sources was the massive 9% growth in value-added solutions.
Oh, yeah. That was their best performance in that category since the first quarter of 2023.
What does that actually mean? Like, value-added solutions sounds like such a corporate buzzword.
It does, but it's actually their secret weapon. It means instead of just shipping parts to a factory, GPC is they're physically embedding their inventory systems right onto the customer's factory floor.
Oh, like automated tool cribs and stuff.
Exactly. Predictive maintenance software, on-site technical support. They manage the parts before the factory even realizes a machine is about to break down.
So it makes the customer incredibly sticky.
Extremely sticky. It's too expensive for a factory to rip all that infrastructure out and go to a competitor. That's how they command that 13% margin.
Okay, so that's the high-flying industrial side. But then we have North America Automotive. And it's solid, but definitely slower.
Yeah, much slower. $2.5 billion in sales, up 3.8%.
And the comp sales only grew 2.6%. I mean, there was some strength in company-owned stores. They were up 4%, and commercial was up 5.5%.
Right, and they did manage to slightly improve their EBITDA margin to 8.2%, but it's just a totally different operational reality than industrial.
It really is. And then you have international automotive, which, at first glance looks amazing. $1.6 billion in sales, up 8.2%.
But there's a massive caveat there.
A huge caveat. A full 4.9% of that boost came purely from favorable foreign currency exchange.
Right. So basically, The US dollar weakened, so the euros and Aussie dollars they made overseas just translated into more reported revenue. It wasn't actually from selling more brake pads.
Exactly.
Yeah.
When you look at the actual comp sales, the real physical volume of goods, it was nearly flat at just plus 0.6%.
What's fascinating here is how management reacted to all this in their updated 2026 outlook. They actually lowered the North America auto sales growth expectation,
Yeah, they brought it down to a range of 2.5 to 4.5%.
but they raised the international auto outlook up to a 5 to 8% range.
So they're really seeing shifting geographical momentum there.
Definitely. The varying performance across all these segments provides a really interesting backdrop for CEO Will Stengel's commentary.
Yeah, he talked a lot about the macro environment. He said they delivered solid results through disciplined execution despite a, and this is a quote, dynamic global environment.
And dynamic usually just means highly risky. If you look at the safe harbor statement and management's commentary, they explicitly mention geopolitical risks.
Yeah, they specifically called out the conflict involving the United States and Iran, as well as persistent inflation.
Right. And obviously, as financial analysts, we're just reporting what management cited as operational headwinds here. We aren't taking any political stance on those conflicts.
Of course not. But why does an auto parts distributor even care about that specific conflict?
Because of global shipping lanes. If there's disruption in the Middle East, ocean freight costs skyrocket, inventory gets delayed, add inflation to that, and fuel costs get super volatile.
So what does this all mean for the spinoff? Because despite all those severe headwinds, they confirmed that separating Global Automotive and Global Industrial into two independent companies is still on track for Q1 2027.
It is. They are pushing forward with the split.
But I have a question about that strategy. If Industrial is this high-margin growth engine, doing 13.1% margins, does decoupling these businesses expose the lower-margin automotive segment to more market punishment?
That is the exact debate happening on Wall Street right now.
Or does it simply free Industrial from the, what do they call it, the conglomerate discount?
Right, the conglomerate discount. Investors who want high-margin industrial growth can just buy the new industrial stock without the slower auto segment dragging it down.
But that leaves automotive out in the cold, right? Facing inflation and freight shocks entirely on its own.
Yes, without the cash-rich industrial segment there to act as a financial shock absorber. Which is why executing a corporate separation in this environment requires an absolute fortress balance sheet today.
Let's actually look at their liquidity and capital allocation to see if they're well-positioned for 2027. Because they generated $464 million in cash from operations in the first half of 2026 alone.
Which is incredible cash generation. And their total liquidity stands at a really healthy $2.3 billion.
And their leverage ratio total debt to adjusted EBITDA is very manageable at 2.4 times.
So they have the war chest to fund this divorce. If you look at their capital allocation year to date, they spent $205 million in CapEx, $38 million in M&A.
And then $288 million paid out in dividends.
Right. If we connect this to the bigger picture, GPC is paying a $4.25 per share cash dividend this year.
That marks their 70th consecutive year of dividend increases. 70 years.
It's unheard of. For retail investors who rely on stable yields, this is a crucial metric. The yield is currently sitting at 3.6%.
So they maintain that streak through the 70s inflation, the 2008 crash, the pandemic.
Yeah, and now they have to figure out how to maintain it while tearing the company in two. How do you divide a 70-year-old dividend obligation between two new entities?
That's going to be a monumental challenge for them. So as you are listening to this and as Genuine Parts Company hurdles toward its Q1 2027 split, retail investors really must consider the future of that newly independent automotive business.
Yeah. How will it weather those future macroeconomic storms like inflation or supply chain shocks without the cash-rich, high-margin industrial segment there to smooth out the earnings volatility?
It really makes you wonder, when this is all said and done, will the sum of the parts truly be greater than the whole? Make sure you follow the show for daily earnings coverage.